Hi, I'm David Clark from Cameron Harrison and welcome to our mid-year economic update, where we take a moment to reflect on what shaped markets over the last 12 months and how our portfolios are positioned for the year ahead. Three key forces defined the past financial year. The first was geopolitical risk, highlighted by oil spiking from around $60 a barrel to over $100 after the start of the Iran conflict. Next was stubbornly high inflation, driven mainly by services and wage pressures, shifting interest rate markets higher. And finally, an accelerating boom in AI-related capex, data centers and memory chips that filtered across a wide cross-section of industries. The message underneath all three is the same. Inflation is looking structural and not temporary. Supply chains, energy systems, defense, and AI infrastructure are all being rebuilt at once, keeping an upward pressure on prices. The outcome is a world that is noisier and more contested, and more inflationary than the one investors grew comfortable with over the past decade. Here at home, the economy improved, but better is a long way from good. Falling mortgage rates lifted real GDP growth to the mid 2% range, snapping a record 8 consecutive quarters of negative per capita GDP growth. Yet, even this modest pace of growth was too much for an economy with such weak productivity, and inflation bounced back above the 2 to 3% RBA target range, turning expected interest rate cuts into 3 increases, lifting the cash rate to 4.35%. The share market here reflected this weakness. The ASX 200 leaned heavily on materials, particularly gold and oil, while technology and healthcare sectors were both down close to 40%, and 6 of 11 sectors failed to keep pace with inflation. Global equities were a sharp contrast. Shown here in US dollars, the MSCI World Index was positive in every sector, reflecting stronger productivity and the broad benefits of higher capex spending. What does this mean for portfolio positioning in the year ahead? Well, resilience today means more than simple diversification. We build our portfolios around 4 key pillars: holdings with inflation-linked revenues, businesses positioned to benefit from the capex spending cycle, geopolitical hedges like oil, and income stabilizing bonds attracting real returns. The goal is a portfolio that performs across a range of outcomes, not one that bets on a single result. This sees our portfolios positioned with our lowest ever weighting to Australian equities, a heavier tilt to global equities focused on AI, energy and industrials, and a higher weighting to interest income, which is yielding a decade high 6.4%. The year ahead will stay noisy and inflationary, but our portfolios are built for exactly that. Thank you for tuning in, and if you have any questions about your portfolio, please reach out to your client service team.